IR Today, brought to you by the National Investor Relations Institute, dedicated to advancing global investor relations practices, and Knowledge Partner host, corporate board member.
Hi, this is Jeff Morgan, and welcome to IR Today. We are at our second year mark. This is our first show of our second year, and we appreciate the support of corporate board member in New York Stock Exchange. And joining us today to discuss a very important issue for all of the issuers and corporate community is Scott Cutler, EVP of Listings at New York Stock Exchange. Welcome, Scott, and thanks for all your support.
Great to be here, Jeff.
So, in the past few days, NIRI, the Society and New York Stock Exchange, filed a petition with the SEC to make some changes in 13F reporting. And this is an issue that we've been talking about for decades, long before I think either you or I were probably involved with our organizations. And it's been great that we've all come together and put this petition forward, and we appreciate the New York Stock Exchange really underwriting this petition. So why now? Why join this effort?
Sure. Well, I think it's important to understand that the 13F provisions are part of the a series of congressional acts that were put in place in 1975, and they apply to institutional investors that hold over $100 million in securities, and as we know, they're required to report their holdings 45 days at the end of the quarter. That provision has been in place since 1975, and with all of the changes in technology, the rapid changes in the marketplace, changes in best practices around corporate governance, changes in the way both boards and companies communicate with their institutional investors, changes with how investors look at their institutional ownership, and maybe even more importantly, the really change in the dynamic of how much institutional investors hold in terms of a percentage of outstanding securities in the United States necessitates a review of this important provision, which again literally hasn't been changed since 1975.
Yeah, it's been a long time. So you've sort of scratched some of the surface here and some of the why, but why don't you talk about what the petition is, and then we'll get into these details a little bit further.
Yeah, pretty simply, it's actually looking at that at that reporting period, and it's a recommendation for the SEC to review those reporting requirements and move from 45 days at the end of the quarter to a recommendation of 2 days at the end of the quarter, and also petitions the SEC to actually work with Congress to potentially review the holding period or the reporting periods to reflect maybe even some of the changes that are coming out in Dodd-Frank Act that apply to short sale provisions, which actually require within the end of the month type of reporting. And so the way we looked at it is that the SEC has the ability to actually change the time period to much closer to the end of the quarter, but it would require some collaboration with Congress and the SEC to move that to under a month.
Makes good sense.
Sorry, end of the quarter.
Right, end of the quarter. From an issuer standpoint, we're all going to jump up and down and say, absolutely, let's do this. This is something that we've been asked to engage more with shareholders. We're going to welcome this. Why is this good for the whole shareholder community and investors in general?
Well, if you look at the original intent behind putting this in place, the actual language says that it was designed for the rapid dissemination of information and disclosure, and that was a fundamental purpose of the bill. It was designed to be able to give the SEC information about institutional investors holding in the marketplace, to understand the influence of those holdings on the marketplace from a public policy perspective, but also to provide transparency to investors in those institutions as well as public companies around timely and reporting. And so that was the original objective behind it. And so I think now you sort of look at what are the burdens associated with having these types of reporting periods, and if there's going to be any pushback, it's going to be sort of from the institutional investor side, I believe, that wants to protect either strategies or positions or the potential impact on stock price movements if their investment strategies are revealed at a shorter period of time.
And I think, looking back to when this was written, technology was a totally different technology platform than today. We've gone through Reg FD and a whole bunch of regulations to really bring shareholders and corporations together in a lot closer relationship. So this makes good sense.
Yeah, absolutely. Actually, when you go back and look at, again, when it was originally put in place, they had originally considered it to be 30 days within the end of the quarter and extended it to 45 because of this notion of an undue burden. But if you look at the changes in reporting now, for example, directors and officers are required to report those changes within 2 days.
Yep.
Public companies are required to file 8Ks within 4 days. And under FD, a lot of times in real time. So there's no question that there's no burden associated with having to report in a shorter period of time. The rest of the market has moved and, quite frankly, operates in a real-time environment, and so it's important. The other thing that I think is really important to note is that, again, in 1980, 28% of outstanding securities were held by institutional investors. In 2009, 73% of the ownership of the top 1,000 companies was held by institutional investors. That's a dramatic change. And if you look at holding periods, you look at hedge funds, you look at some of these big institutions, holding periods are now, turnover rates are 35% within the quarter. So again, if anything, the information that we have today, existing rules guarantee that the information is meaningless.
Yeah. And issuers across the board realize that.
Right.
And the challenge that we have is engaging with the right shareholders based on the guess that we have of who owns our stock. So let's go a little bit more into depth about the institutional investors and, give us a little bit more on the argument there of why they really need to change and why this just doesn't, the world has changed and they need to change as well.
Yeah. I think the biggest argument supporting the time period is essentially that tipping the hand to the market. Be able to have a sufficient amount of time for the market to absorb sometimes investments that can potentially move the market. And I understand and appreciate that from an institutional investor view. But I also take the other hand of it. If I'm an investor in an institution and I want to know what that fund is holding, I'm not even going to know that. If that position was incurred on January 1, I'm not going to know that until May 15th.
Yep.
That's a significant amount of time. And so there's an argument for investors to look at it. And then I think from a public company standpoint, the big issue there is really the trends, and I think we can talk about that in a second, but the trends towards governance is much more associated with understanding and knowing who your shareholders are and communicating directly with them.
So New York Stock Exchange, because you're an exchange, you have certain powers, where in this case, you may not have certain powers with the petition. So tell us what happens now with the petition.
Right. So this is actually on. It's an act of Congress, and that act of Congress directs the SEC to adopt rules consistent with that act. The petition actually is asking for the SEC to review those rules that they've put in place. There's no requirement that the SEC respond to this petition in any period of time. And I think it's important that if you are a company or if you're an institutional investor or a listener on this show, it's really important that you either sign on to the survey, sign on to the petition, send an independent letter down to the SEC expressing your support for the review of these provisions, and to actually have a collective voice. And one of the challenges on some of these things is that issuers collectively haven't necessarily, taken up the pitchforks and taken up the petitions to say, hey, this is really important. And in today's environment, particularly with the pressures around communicating with shareholders, it's imperative that they do.
Yeah. And I think that by doing this, it creates this broader discussion. And let's have that discussion publicly. And I think we're not only going to see issuers support it 100%, but a lot of investors say, yeah, so if I'm a long-term investor, I don't want those traders getting in the way of me having a dialogue with the company. So,
absolutely.
So you had mentioned good corporate governance practices, and you also with Dodd-Frank, there's other things happening, looking at short selling and sort of looking at the definition of beneficial ownership. So any final thoughts on this?
I think the final thought is simply if you look at some reports that came out. The American Bar Association, Business Roundtable, ISS, Glass Lewis have all said it's critically important today to communicate with your shareholders. And the confluence around investor relations and corporate governance is here. If you look at proxy access, if you look at say-on-pay voting, you got to know who those shareholders are. And so I think from a governance perspective, these things are coming together. And I think one of the good things that came out from Dodd-Frank, among the 500 different rules, one of them was actually looking at the short sale reporting requirements, which under Dodd-Frank require the SEC to shorten that to within days at the end of each month. So again, like I said earlier, having a harmonization disclosure set around these things makes a lot of sense.
I want to end, and I think we could talk about this a lot longer, but I want to remind our issuers and really everybody that's listening to this that this is an important issue, and it's something that we want everybody to read. So this is posted on the New York Stock Exchange site. This is posted on NIRI's site. You can get it from the SEC. You can get it from the Society of Corporate Secretaries. And we're looking forward to this dialogue, and this is the kickoff of this. So Scott, thanks for joining us. Thanks for your support. Thanks for underwriting this, and we look forward to further dialogue, and we look forward to seeing you on the next IR Today.
Join us again next time for IR Today, brought to you by the National Investor Relations Institute, dedicated to advancing global investor relations practices, and Knowledge Partner host, corporate board member.